Hey there, and thanks for watching. Over the next few minutes, I'll be walking you through my self-storage development. Now, this model was built based on my apartment development model. I took that and I adapted it for self-storage. And then I've since added various modules. As of this video, we're on version 1.5, which is about 10 iterations of this model since our initial release. Most recently, I added a permanent debt feature where now you can model both merchant build scenarios or build, lease, sell, as well as build to core scenarios, build, lease, and then hold. And so let's dive right into the model. What you'll find here along the bottom, when you open the model, there's really three worksheets that are visible. The version tab, of course, where you can see what has changed with the model recently. And so if you download the model and you're looking at a newer version than what I'm sharing in this video, you'll be able to see what has changed. We also have a summary tab that summarizes the investment specifics as well as key assumptions and returns of the scenario that you're modeling. And then we also have here below some charts to help you visualize cash flows as well as returns, both at a property level as well as a partnership level. Next, we have the underwriting tab. And if you're familiar with any of our other single tab underwriting models, the apartment development model is a good example, but we also have an industrial development model where all of the assumptions, with a few exceptions, lie on this worksheet. And the reason for that is to simplify the process and speed the time along to underwrite a deal while keeping a model that is as robust, if not more robust, than most of the institutional models that you'll run into out there. Most of the institutional models that you'll run into out there. And so to make it easier to navigate through the different sections of the model, you'll see along the top here we have navigation buttons. So you can either scroll up or down to the various sections of the underwriting tab, or you can just click, say, to the investment description or to the development period cash flow section. You can go to the operating period cash flow section or the reversion or sale cash flow section. Then we have the returns where you can visualize the roll-up of the cash flows from each of the various sections of the model, as well as view property-level returns. And then we get down here, partnership-level returns. And this has the ability to do both a single promote, where you have a GP and an LP a structure, or a double promote, where you both have a GP, a traditional GP and an LP structure, but then there may also be a promote at the GP level where the GP has investors as well in that structure. And so again, toggles as such. And then the final section is sensitivity. Now let's talk through each section one by one. Description. Again, this is where you line out the just kind of descriptive elements of the property. What's its name, where it's located, when does your analysis begin, how many buildings are in this project, what's the size of the land, what's your net rentable area, and that automatically is calculated, how many stories is this development, what's your gross buildable area, how many units, etc. Right? So this is just summarizing the description of the project. And then we have the development period cash flows. And this is where you first line out your construction budget, and then you select your forecast method and the timing of the forecast for each of your line items. So for instance, we have land costs, and you might have, so the land purchase price, and there may be, or there will be a month when you purchase that. So in this case here, just the default is in time 0 of your analysis, you purchase the land. This is the amount. And so out to the right then, so all of the assumptions fall within columns B through I, and then out to the right, you see the result of the assumptions you make, again in blue font cells off to the left, if you're familiar with a modeling convention. Out here to the right, then you see the calculation, and you can see the cash flows in each period as they flow into what we call our real estate DCF. And so land costs, By default, all of those happen in month 0. Then we have hard costs, construction costs, other hard costs, and you can click these little buttons right here to add items or delete items from any of these sections. And then we choose a forecast method. So here we have construction costs start in month 1. Let's say we want those to go until month 18. And then we want the forecast method, and we have 3 options: straight line, S-curve, or detail. Let's say we want the hard costs to be S-curve, meaning they begin at a lower amount in the early months and the latter months of your forecast period. But in the middle months are when you have the most. So it goes out in a bell curve shape. And you'll see that here, right? In month 1, 10,000. By the time you're in the middle of the range here, in month 9, 553,000. So that is an S-curve. But you can also go, say, straight line. And when you go straight line, you'll see out here to the right, every month is the same from month 1 through month 18, right? But construction costs tend to be more in an S-curve fashion. And then again, we can change that for each line item. So other hard costs, let's make that 18, and then you can add, like I said, additional items there, or you can click the add button and that will actually add lines. Then we come to soft costs, and you'll notice that by default, 1 through 12, maybe we make this 18. Leave that straight line. These are the amounts. So we could change any of these amounts. Let's say that our marketing, let's put 125,000, and it'll update out here to the right. In fact, and let's make our marketing, let's have it start in month 12 and go through month 24. And so you'll see now, as we go out to the right, it begins in month 12, continues out through month 24. Now, as we're making changes, you'll see up at the top a red button will appear. Click to recalculate. So what happens is, and now I'm getting into our carry costs, which in this model, carry costs are financing costs, construction interest, and then any operating shortfall. So once you complete construction and you begin to lease up, you'll have some operating expenses that aren't fully covered by rent until you hit a break-even point. And so that's our operating shortfall. And several of these items, namely construction interest and operating shortfall, are iterative, meaning they're circular calculations that can be handled a couple ways as we're modeling. And the way I prefer to do that is to not use Excel's iterative calc feature. And that there's a variety of reasons for that, but I've chosen to do that. And instead, how it works is anytime the model finds that it needs to reiterate, it needs to recalculate construction interest or operating shortfall, this button will appear up here. And all we do is you click it, and in the background, it iterates, and it recalculates the construction interest. And as soon as it has found that it's hit now where it's supposed to be, that button will disappear. And so anytime you see that button that's red, you'll know that you'll need to click that before you can finalize your analysis. So that is the end of our what we call uses in our development cash flow section, or our project costs. And then we have sources, right? And so your sources are sources of capital to cover your uses. And so your total sources must always equal your total uses. And sources are a combination of debt and equity sources. And so here we can enter an amount for debt. That's a loan to cost. So we say, okay, what percentage of the 7722 will be covered by debt? And the remaining will be covered by what? Equity, right? So let's say we're going to do 70% loan to cost. Now, as soon as I make that change, you'll notice this button turns red. However, if you look here, this value, if I go back to 65, doesn't change. And that's because this is changed by this macro. And in fact, if you look in this cell, I-54, notice how it's a kind of an odd number and it's a hard-coded value. That's because when you click this button, it essentially changes this cell iteratively until the loan to cost is 70%. And in doing it, it changes that and And this capital, our construction interest and our operating shortfall, as our equity amount changes, those change. And that's why it's an iterative logic statement. So again, we're at 70. Let's click to recalculate, and you'll see both of these will change when we do that. There we go. This is the equity amount. This is the debt amount at 70% loan to cost. And you also see interest and operating shortfall slightly change. Now, under debt, we can also choose either a fixed interest rate or a variable interest rate. And when you change the variable out here to the right, you'll see you can model out some variable rate by period. And then we continue to move down. Those are we get to total equity. And then we see our debt, and you can see the debt broken down into debt before reserves, and then we have an interest reserve and an operating shortfall reserve. Our total debt amount, this 5433, matches our debt up here in the summary line. And we add debt with equity, and we get our total sources. Now, at this point, you have the option to choose whether you're going to use the permanent debt module or not. What that really means is, once your property is stabilized, is your intention to refinance the construction loan and hold this long term, or is your intention to sell? If your intention is to sell, you leave the perm debt. Most likely, you're going to leave the perm debt off, or you click this no perm button. If you want to use permanent debt, or in other words, you intend to hold this long term, refinance your construction debt, you'll click this perm debt button. And you'll see now all of the perm debt module components become available. This is one portion. These are your assumptions. So you select, okay, when does the permanent debt fund? And that date will line up with your the payoff of your construction loan. So let's say that right now, by default, it's set to be the first stabilized month. But let's take it, let's do, 3 days after that. So we go like that, and you'll notice the payoff of the construction loan goes to month 38. This is the loan funding for our permanent debt. And then what's the rate? By default, it's 100 basis points below the fixed rate on your construction debt. That's just a filler. So you'll enter some value there. You can choose whether this is interest only or amortizing. Now, there's not ability to do partial interest only. Kind of a weakness of the model. At some point, I'll add that in. But in the meantime, in most instances, you're either all IO or in many instances, you're either all IO or you're amortizing. So you choose whether you're going to have interest only. If you do, toggle that to yes. Now there's no amort period. You got a payment there, or we go to no. And if it's no, then you choose, okay, it's amortized over 30 years or 25 years or 20 years. Keep that at 30. It calculates for you your payment and then the loan amount. So by default, the loan amount is equal to the construction loan payoff. But perhaps you think you can get more. So 5.4, maybe we think we can get 6.5. There will actually be now some return of equity, right? Because we owe 5.4. We're borrowing or we're refinancing with a loan that's 6.5, there's going to be a little over $1 million in equity that will be returned to the partners at this stage. And then we continue now. That's the end of the development cash flow section. Then we move to operating cash flow, and this is fairly self-explanatory. You do have the ability to choose a detailed lease-up method, which is basically you set what percentage is leased up or not, or a basic. And the basic works, you choose what percentage is pre-leased, then how many units per month are you going to lease up. You also have a assumption, how long is your contract length? So maybe you have month to month, or maybe you do 12-month leases, maybe you do 6-month leases. What's your average typical lease? You have some annual income growth rate and when that begins, as well as an operation begin month. And by default, this is 1 month following the end of your construction period, but perhaps you deliver sooner than the construction ends. So maybe you have a multi-phase deal, and so you're actually going to deliver in month 18. By default, the growth begins as of your operation begin, but you might change that to say month 1, and then your rental growth rate is going to grow from the beginning. Then you have your rent roll. Again, very self-explanatory. You have some concessions, that's free rent, and you can choose whether those concessions persist beyond the lease-up period, and it's just a percentage of your gross rent. And you can choose to detail that as well. So if you choose to detail it up here, you'll see you can actually set a concessions amount in each period, or we can just keep that as basic. And then you can have non-revenue units. So maybe you have units that you provide to employees, or units that are left aside for marketing to show. So you set how many units are non-revenue units. You have some other income perhaps, and that other income grows based on your annual income growth rate. You might have then a general vacancy, and this just hits your vacancy, your total potential income by some percentage. Then we have operating expenses, again, very self-explanatory. There's an expense growth rate and when that growth begins. You have a property tax percentage of full assumption, and the thinking goes that in a development deal, your first year or two of operation, your property taxes aren't fully stabilized. As you're leasing up, they're increasing over time until they hit what we would call a stabilized operating or a stabilized property tax number. So you can choose that, and if you're in a jurisdiction that doesn't have that, then you can set that to 100%, but it's the percentage of what you set here as your stabilized property tax number. That is the percentage used in each of the first, second, and third year of operation. CapEx, again, self-explanatory. You have the ability to have other income and have that go out either straight line, or you can detail other income or other capital expenditures, I should say. And so that's our operating cash flow section. Then we have a reversion cash flow section, and this is your sale. And what we have is a market cap rate today assumption, a cap rate at sale assumption, and then selling costs. And then you can build out your actual sale pro forma. So by default, this is going to grab the forward-looking 12 months, but likely this pro forma will need some adjusting. So you'll take the forward-looking 12 months, you'll make any adjustments that you think are necessary. You arrive at a net operating income line, and then based on the cap rate at sale, a sale value right here, stabilized value, will be calculated. So we assume that the untrended value of this investment, if this were built today, fully stabilized, it'd be worth $8.6 million. If we were to build it and there was some growth, and once we stabilize, because of a little bit of growth in NOI, we believe that the value would be, say, 8.7. We call that a trended value. And then at sale, and in this case, because we're using the permanent debt module, by default, it's assuming a 10-year hold. Out 10 years from now, we think this is worth $10.8 million. Now, by the way, we're building this for 7.6, right? So that kind of gives you an idea. You can compare. Today, we're going to build it for 7.6. We think it's worth 8.6 when it's done in today's dollars. So there's about $1 million in value creation in this development. So that's the reversion cash flow section. And then you have the returns. And this is where you have just kind of the roll-up of the various sections up above to arrive at a net unlevered cash flow and a net levered cash flow line, which from those lines, IRR and equity multiple are calculated. You also have a yield on cost calculation, and when you compare that to the market cap rate, you get a development spread metric. And so you might have, internally, we're looking for investments with at least 100 basis points of development spread on an untrended basis. This is only 80, and therefore this may not be a deal that has the return that justifies the risk. Or maybe 75 is your threshold, and in that case, this would pass that test. Then we get into partnership level cash flows. The assumptions, again, are, if you've used any of our models, are fairly straightforward. You have a contribution percentage due from the GP. The balance is covered by the LP. So if you recall up top, there's $2.3 million of equity required. This is how we break it out between the GP and the LP. So the GP is going to come up with 10% of that, the LP 90%. We then have a tiered waterfall. In this case, we have a 4-tier with a preferred return and return of capital tier, followed by 3 promote tiers. And so here are the hurdles for each. Here's the promote in each. This is the distribution percentage between the GP and the LP in each of the tiers based on this promote. And then down below, you see a summary of the GP's distributions, all right, and LP's distributions. Here are the GP and LP's contributions, and then a net cash flow, otherwise known as a net profit to the GP and to the LP, as well as their respective IRR return and equity multiple return. And then finally, sensitivity table. Let me first click to recalculate. Now here what we can do is we can sensitize various metrics. So we click to update the sensitivity table, and what it will do is you can you can change any of these as you'd like. By default, I have vacancy, exit cap rate, expense growth, and income growth that I'm sensitizing here, but you can really adjust this table to your liking. So that's the sensitivity analysis section. And with that, I've showed you the self-storage development model. Let me know if you have any questions about anything here. And if you have any feature requests or you find a bug, please let us know, and I'll work to roll out a update. Otherwise, thanks for your time.